4 important real estate topics I wanted to share to pique your curiosity. Number 1, how home ownership can help you hedge against inflation. Number 2, I demonstrate how you can predict where the interest rates are going to go. Yes, you. And number 3, an update on the forbearances. And number 4, the local Seattle market update. Now, these topics will help you understand both what's happening nationally and its impact locally. Ready to explore? Now, fasten your seatbelts and let's go. Hey, Ravi with Ram's group at eXp Realty here. If this is the first time we're connecting, I welcome you to my channel where I strive to provide meaningful, relevant, and educational content to help both home sellers and buyers be in the real estate know. By the way, I've included the timeline in the description below should you want to directly jump to the relevant topics, okay? Now, back at it. First, let's discuss how homeownership provides a hedge against inflation, okay? I'd like to share a quote from Investopedia. It says, "Real estate is one of those time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns, unlike paper assets. More specifically, as prices rise, so do property values." So home ownership is one of those things where you can lock in the cost today. It's an asset that increases in value over time as prices rise. You locking in that fixed cost of ownership is really a hedge against inflation, okay? And here's a chart that shows you how home ownership outperforms inflation over time. This is home price appreciation versus the consumer price rises over the decades, and it goes way back to the 1970s. Now, what you're looking at here is the blue bars are the average inflation rate for the decade, and the green bars are the average home price appreciation for each of those decades. Now, let's look at the 1970s to start. Inflation increased at 7.1% in that decade, and home values appreciated 9.9% in the same time period. So, home ownership did outperform inflation. Now, in the 1980s, it was a little bit more balanced, 5.6% inflation and 5.5% home price appreciation. And let's look at the 90s. We start to see the home values tick up again a little bit more, outperforming inflation throughout that decade. Now, to the 2000s. Times were very different, weren't they, in 2000? Home prices performed at a very different rate than what we've seen in the many other decades prior, and even what we're seeing today. We also had a different housing market then. We had an oversupply of homes, and the lending standards were vastly different as well than they are today. Also, homeowners didn't have as much equity in their homes as they have today, right then, in the 2000s that is. So things were way different. So home prices did not outperform inflation in the 2000s, but look at 2010s. This is where home values really started to kick in. Homes started appreciating much faster than inflation, 4.9% versus 1.8%. And then in 2020 and 21, we know what happened, right? Massive home price appreciation, right? And was when home values outperformed inflation. So over time, home ownership is generally looked at as this great hedge against inflation because home values are performing better than the inflation rate. Now, after looking at the chart, if I were to ask you, where would you want to be in inflationary times? I'm waiting for you to answer. That's right, in an asset that's outperforming inflation, correct? That means someone buying a home today can lock in the home's cost and protect themselves against the rising cost of inflation. Now, let's talk about renting, because renting takes on the risk of rising rental prices year after year, as you know, right? And rental prices around the country are truly skyrocketing. Yeah, and we're seeing that. Now, I'd like to share a bank rates quote for renters. It says, "A fixed rate mortgage allows you to maintain the biggest portion of housing expenses at the same payment. Sure, property taxes will rise and other expenses may creep up, but your monthly housing payment remains the same," which is true, as you know. Now, this is making owning a true advantage. Also, all the forecasts that we've seen show that home values are projected to continue rising. So instead of continuing to pay rents that will increase year over year, it makes true sense to own. Now, what do you think about it? Yeah, that's true. Now, you may wonder, well, how do rental prices react to inflation? We saw home prices reacting to inflation, but what about rental prices? That's a great question. Here's the data that shows how rents compare to inflation, starting from the 70s. So the blue line is the core inflation rate, and the green line is the rental price appreciation. And as we can see, the green line is higher than the blue line in most scenarios, to mean that the rental prices have increased faster than inflation, mostly. Yes, there were some ticks down below that blue line. However, that means it's more expensive to rent over time because rental prices are continuing to rise faster than the rate of inflation. So if you're renting, it becomes important to buy now, if you can, to avoid the increasing costs of rent when there's inflation all around us. Wouldn't you agree? Now, home prices are going to continue to appreciate. According to 100 economists and data analysts who were interviewed, they projected that home prices would increase anywhere from 23.7% to 62.5% overall by 2026. Now, there were three groups of people predicting where the prices would head by 2026. And even the pessimists said that prices would appreciate at least at 23.7%. Now, this is pretty good over 5 years, don't you think? So, if you're renting, this is something for you to seriously consider. Then let's move on to the mortgage rates. As we head into spring and summer, the mortgage rates are expected to head higher. And homebuyer demand continues to be elevated as the supply remains low, driving home prices higher. Expect to see rates go up in March, and we are about 3.55% on the average 30-year fixed. Going back to the beginning of 2018, the rates were higher back in 2018 and 19 and started to come down and then dropped to historic lows during the pandemic. And we are starting to come out of that right now. Now, with more entry-level buyers coming into the market, we'll see a housing market that is super competitive this year, right? Again, going back to the supply and demand. Now let's look at how historic interest rates worked. Now, if you're currently at 3.55%, going into 4%, which I think we'll see very soon, that's still a very, very favorable rate. When you go back all the way to the 70s, we're seeing the average 30-year fixed by decade going to the 70s, 80s, 90s, and beyond, right? You do see that we are at a very, very favorable rate bracket in comparison. Wouldn't you agree? So it's going to feel like we are heading higher, but when we look at it historically, we are still very, very good comparatively. Also, I'd like to share with you about how you can predict the interest rates. Are you ready? The answer is simple. It's all tied to the 10-year Treasury yield. Let's take a look at the 10-year Treasury graph going back all the way to about 50 years. Now, the relationship between the mortgage rates and the 10-year Treasury yield has almost been symbiotic, right? Wherever the 10-year Treasury yield goes, the 30-year fixed rate goes there as well. Now, the Fed increasing the rates does not control the interest rates, just so you know. However, it has a great influence on it. Now, what we want to watch is the 10-year Treasury yield. When we started the year, the interest rate was about 3.1%. And where we are right now is around 3.5%, 3.55 to be precise. And where we are going is 4%. And I'm not saying that we're going to stop at 4%. While I do not have a crystal ball, that's certainly what the outlook from the analysts is saying. Now, you can find the mortgage calculators online, plug in the total price of the home that you're looking for, plug in your down payment, and see what the difference between having paid 3% versus 4% would be, okay? Now, while I'm not trying to convince you to do anything, the numbers that exercise will reveal to you should more than explain the cost advantage that you would have buying today rather than waiting, okay? Now, let's quickly talk about forbearances, okay? Before we delve into the local real estate market data. Take a look at this graph. Now, loans and forbearance have fallen below 1 million. This is huge. Woohoo! We are at roughly 780,000 loans in forbearance today. And that equates to only about 1.4% of all the mortgages outstanding. Now, if you think about where we started, the red bars on the left, there were nearly 5 million homes in the forbearance plan in May of 2020. And now we are down to about 780,000. So that's great progress there. And I am truly, truly excited that so many homeowners were helped to deal with their economic uncertainty during the difficult and challenging times. Now, after tackling those three items, number one is how home ownership helps hedge against inflation. Number two is the rising mortgage rates and where they're headed. And number three, taking a quick peek at the forbearances, let's quickly look at what the local stats in the three counties, King, Snohomish, and Pierce, are telling us. In King County, the new homes that came on the market in January of 2022 was about 20% lower than what it was in 2021. And nationally, the inventory is super low as well. And for condos, we saw a similar decrease as well. We can attribute that to two reasons for people to extinguish the condo supply. Number one is many people are being priced out of single family homes, and the next best thing for them to own is a condo, or at least that's what they feel. And number two is the rising interest rates combined with the FOMO, which is fear of missing out, is making people want to own something instead of nothing. And as an alternative, buying land and constructing is the next best to buying pre-constructed homes, correct? However, there being a dearth of land inventory as well makes it a no-go for many. Also, looking at the inventory situation in Snohomish and Pierce counties, the situation there is not as dire as it is in King County. However, it is scarce there as well. We are seeing scarcity everywhere in inventory. Now, instead of bombarding you with data, I have included the charts for all the three counties below for you to take a look and make sense out of. And as always, I'm happy to shed further insights or answer any questions you may have. Now feel free to direct message me or get in touch through other methods, which I provided below as well, and I'm happy to find details for you. Okay. Now, moving to the pending homes, which are the homes that went under contract. This tracked closely to the number of new listings that came on, to mean that the rate of incoming homes went under contract right away. However, Pierce County was an outlier. Now, why do I say that? The number of pending homes there was similar to what it was in 2021, to mean that though less new inventory was coming on, the number of homes going under contract was similar to that of the last year, which means that the Pierce County single family homes market is hotter than it is in King County. Now, one reason is that the pandemic is making people move out to the suburbs, buy homes there, which they can afford. And this could be a short-term blip. However, I am monitoring the market and I shall keep you posted. Now, looking at the days on market until sale for single-family homes in King County, it was 17 days. Now, this is the average across all the homes that came on the market. And this could be that homes that were priced higher, sitting a little longer, skewing these numbers. Now, if you were wondering, wait, homes are going under contract in 5 to 6 days approximately after launch, and this number 17 does not make sense, which is why I said that this is the average across homes at all price points and their condition. Homes that don't show great are overpriced are still sitting even in this market. And the days on market in King County, even with a few odd homes sitting on the market, was down by a 34% number from the last year, which means inventory is tight. And yeah, that's the situation. Now, moving on to condos, while in King and Snohomish counties, the condos went under contract sooner than Pierce County, condos stayed on the market much longer in comparison in Pierce County. Yes, people are moving to the suburbs and choosing to buy single family homes rather than condos, as it offers more home for their money, right? It's logical, if you will. Now, the average price of homes in King County compared to Jan of 2021. This increased by about 12%. Now, do not be misled, as this is only a comparison between 2 Januaries, because the average price appreciation for all King County homes was close to 19.5% for all of 2021. Now, while King County's average price from Jan 2021 to Jan of 2022 rose by 12%, Snohomish, on the other hand, rose by 24%. Yes, double that of King County. And the reason is that people who are priced out of Bellevue, Redmond, and Kirkland are moving up in troves to the north, like Mill Creek, Snohomish, Everett, to name a few places, making the prices there spike up as well. Another metric of interest would be to look at the sold to list price ratios. This will let us know if there were any price escalations. It is interesting to see that the sold to list ratio was just 106% in King County. Now, you may be wondering, wait a second, this seems to be less. You're right there too. It is the average. Now, King County is huge, as you know, and there were homes that went way above ask and a few homes that sat on the market for long, attracting lower prices to pull the curve downward, right? It goes with the saying that overpriced homes sit on the market way too long, no matter which market. And this is an example. And finally, the months of inventory. This is how long the existing homes that are listed on the market will take to sell, assuming no new homes came on the market. In King County, the months of inventory was 0.2 months, which roughly translates to 6 days, which is just about right? With the way the homes are flying off the shelf or going under contract. Now, the number across all 3 counties has been hovering from 0.1 to 0.4 months, which translates to 3 to 12 days. And based on really how low the inventory is, this is not a surprise, if you will, as home keeps flying. As soon as they come on the market, they go under contract. Hey, a detour. If you like the content I've shared, consider subscribing. I hope to bring rich real estate content to keep you updated. Feel free to comment below this video and let me know if the data was useful, if there were any aha moments, what you'd like to see more of for me to bring that data to you and content to you, okay? And I totally appreciate your support. Now, with those insights, here's a wrap. We saw how homeownership provides a hedge against inflation and how low inventory coupled with the soon-to-be rising interest rates is causing a big buyer frenzy, pushing condo and home prices up to crazy levels, and how homeowners who seeked out to get forbearance are coming back to resume their normal mortgage payments. And finally, we also took a look at the local real estate market data. While the effects the pandemic may have left behind is something that we all are dealing with, increase in home inventory is the only solution that will bring in the needed reprieve. While the rising interest rates is a concern, I would prioritize it lower because when people are escalating close to say 30 to 35% over list, a half to a 3/4 point increase in the interest rates is not going to have a huge dent in comparison, correct? Of course, home affordability will go lower, and that's about it with rising interest rates. That's it. Thanks for tuning in, and until next time, you stay safe, and I will talk to you soon. Bye-bye.